Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. Markets, a mixed bag today. The latest stock rally has cooled a bit as we wait to hear more from the Fed this week, and as tariff turmoil lingers, we'll have everything you need to know about what the market moves mean for you. And what is the state of freight? The shipping industry is experiencing a downturn, particularly in ocean container cargo from China to the U.S. due to tariffs. We're speaking with a leader in the space, Craig Fuller, CEO of FreightWaves, for a deep dive into what it all means for investors and consumers. And concern about tariffs is adding cracks to construction and engineering businesses. We'll see what bearing, if any, it has had on Limbaugh when it reports earnings today. The company has a market cap of about $1 billion, and we're talking to its CEO. Well, a new era is ahead for the global freight market amid President Trump's trade policies, from changes to the labor force to supply chain risks. There's a lot to keep track of in shipping and transportation. Craig Fuller, FreightWaves founder and CEO, joins us now to discuss. Craig, it is good to see you. So listen, maybe just start at a high level, Craig, because obviously you know the freight logistics market as well as anybody. What are you seeing, Craig, in terms of voyages and freight? What are the themes? What are the trends?
Yeah, there's been a significant drop in volume from China, and that's starting to show up in the United States. So if you think about really since Liberation Day, since they went into effect on April 9th, we've seen a 60% drop in outbound cargo out of China to head to the United States. And in terms of what we're seeing right now, that cargo that would have been here is now showing up or not showing up in the United States. And so over the next 2 weeks, we expect a 35% drop in year-over-year cargoes into the port of Southern California. So this is Port of Long Beach and Port of LA, and that will actually start to show up in the rest of the country in terms of a lack of cargo over the next couple of weeks.
Well, that's what I want to get to, Craig. Like, if retailers, for example, are taking in less inventory, when would the consumer expect to see that on their local store shelves? When am I going to really see that? Is that more, I've heard different estimates. I mean, I've heard summer, I've heard fall, but what do you see?
Yeah, it's going to be intermittent. So you may go to the store and have a certain product that you normally purchase, a brand. It may not be there. So it could be everything over-the-counter medicine to batteries to apparel. You may go to the stores and the stuff that you normally buy just aren't in stock. There may be an alternative brand. And that's really the first part. That's really June and July that's where it's more likely to show up. As we move into the calendar, back to school is about the first time that I would expect most people in America would likely see inventory stockouts. And so this is when mom is getting her her kids ready for school, backpacks, school supplies, things that they normally go to buy will be in selection. That's when I think most consumers will realize it. As we move further into the calendar, as we move towards Halloween and Christmas, this is all dependent on how fast or if we get a deal. So if we get one in the next month, then really Christmas is saved. If not, I'd be really concerned about having an enormous amount of goods that aren't in stores for the holidays.
And Craig, how many people roughly work in logistics across the country? And how at risk do you think, if this continues, would some of those jobs be? And where would the risk be, Craig? Would it be, truckers? Would it be dock workers?
Well, I'd say the risk is all of the above. There are 9 million people who work in transportation in the United States, transportation and logistics, moving freight, moving cargo. So when we look at the amount of volume that is directly to imports, it's 20% of the domestic trucking volume is directly rated to imports. And so if we think about what that means, dropping off as much cargo as we currently don't have or don't expect to have, is we're expected to lose 5 to 6% of total trucking volume over the next month. And that means you would likely see a roughly equivalent amount of job losses. Trucking and logistics is an industry which doesn't get a lot of benefits of scale in terms of human capital. As there's more volume, you add more people. And so we think about losing 5 to 6% of 9 million people that work in this industry. We're looking at 400 to 450,000 jobs that are really at risk.
What if, Craig, we do start getting trade deals done? How quickly could some of the trends and themes you're talking about here get reversed, or at least eased?
I think it's all on China. So much of the rest of the world, these tariffs that were initially rolled out, that were put on hold or put on pause, really are sort of a secondary story. They're not that important in terms of freight volume because most companies can absorb a 10% cost. Now, if we do see 40, 50, 60% tariffs that were teased, then we're talking about a different situation. But right now, everything is about China. And so we talk about the drop off in ocean container volumes. We actually are seeing an increase in places and other parts of the world like India, Vietnam, and even Europe in terms of cargo because companies are trying to front run those tariffs that potentially could be coming down. But everything is on China. So when we talk about the drop in volume, it's really what's happened in China. It's the 145% tariff. And effectively, as the administration has admitted, that's an embargo on trade between China and the US. And so when we look at the types of products that are mostly impacted, it's manufactured goods, particularly high volume, low cost manufactured goods are the ones that consumers are going to notice that probably inventory stock out. And it's the ones that are creating the most stress in the system.
I'm curious, Craig, because you've been studying these markets for a long time. How would you compare and contrast what we're seeing now with what we saw during COVID?
It's a very, very similar sort of eerie situation. I think talking to people that are directly on the front lines that handle this business, what they will tell you is it feels eerily like COVID in the sense that nobody really knows what's going on. Some companies are operating different, but everyone's sort of confused. Everything's on pause. And so it feels eerily similar. When you look at the data, it actually looks in terms of where we're at in volume, very similar to the amount of volume and the drop off we saw in early COVID. So to me, this is a very close situation to COVID. The only big difference between this particular crisis in supply chain and the one we saw during COVID is that the government came and bailed us out. So the short-term pain that we saw in COVID in terms of dropping off of freight volume was very short-lived. That V-shaped recovery happened really, really quickly. This time, it doesn't look like the federal government or the Treasury is going to come bail us out. So the Federal Reserve doesn't look like they're going to print a lot of money or do QE, nor does Congress look like they're going to do a lot of stimulus. And so you potentially won't have this aggressive V-shaped recovery coming because there isn't a lot of money to help consumers sort of absorb the shocks and the layoffs that may be coming.
Craig, great to see you as always. Thanks so much for your time today. Appreciate it.
Thanks for having me.
Stick around, much more Asking for a Trend still to come. Stocks closing lower in today's trade with the S&P 500 snapping its longest winning streak in over 20 years. Yahoo Finance's Jared Blickry joins us now with the trading day takeaways. Jared.
Thank you, Josh. All good streaks must come to an end, almost by definition. So streaks don't last, but we still have some going on, not just in the S&P 500 as of Friday, but check out all these. These have advanced to 10 or more. We got Cisco up 9.1%, Workday up 16% over the last 10 days, Cognizant up 14.5%, gets better. Zscaler up 20%, and American Airlines up 17.5%. Carvana, that old meme stock from back in the day, that's up 32.5%. But what's really interesting here is the FTSE. The FTSE's here up 3.9% in that time. Let me just show you the last month in candlesticks. Just about every day since April 8th, since we kind of got that trade tariff detente with Trump, that's a lot of T's, we have been up every single day. So that's 15 in a row for the FTSE. I believe that is one of the best in history. And if you remember from earlier in the year, Meta had one that was 20. That kind of blew my mind. So we'll have to see if the FTSE can catch up there. But suffice to say, it's been a good run.
So streaks are nice.
Yes.
They're noteworthy, but where have been the biggest gains, Jared?
Yeah, and let's check that out because we got to look at who's leading here. I mentioned that April 8th low, so I'm going to show you a different screen. We were just looking at the last 10 days, but now I'm going to look at the last, I think it's up to 18 or so, and we're going to go to the sector action here. And we're going to hit this button, and there we go. So tech is up almost 20%, 19.9%. That's a good total for a year, maybe even 2 years, but that's just a few days here. Industrials up 15%, materials up 13%. The laggard is healthcare up 4%. So it's just been a really kind of, I don't want to say free-for-all, it's been very inclusive. I mean, you look at the top sectors. These are my leaders, by the way. You look at some of the top leaders, cannabis, ARC, so that's innovation, disruption, but then you got software, you got Bitcoin in there, you got New York FANG, which is some of the Mag 7, IPOs, momentum, we got chip stocks, so a very broad swath. And as is clear, everything is in the green. And the low-hanging stuff here, up only a little bit, that's pretty much historically conservative stuff that doesn't necessarily move a lot. I'm just gonna show you one more thing here. Here's the NASDAQ 100, and we got some really nice gains. And if I'm counting the red squares, it's only 3. And the big question is, can this continue? S&P 500 still has some work to do. As I was going over at the 4 p.m. bell, we're kind of in the middle of the range. If you take that February 19th high, that was the all-time high, to the April 8th or so low, well, it's right about in the middle. So a little bit more work to be done, but off to a very nice start here with this rally.
You mapped out who's gaining, who's losing.
Well, the VIX is down, but that's because equities are up. Those move inversely, and I'm being kind of flipped there. But let's check out the futures, because I've been tracking crude oil. This is a little bit concerning. So I'm gonna put a year-to-date on the crude oil chart, and this is WTI, by the way. You can see it's been a steady stream down here, and got no relief bounce after those tariffs. And so crude oil kind of speaks as to the global demand picture. I'm gonna put a 6-year chart in so that you can see this is the lowest that we've seen since about early 2021. So crude oil is kind of a barometer for me. Drill, baby, drill. Sure, that's going to lower gas prices, but the flip side of that, while it's nice to have cheap energy, is that, well, you don't want global demand to just evaporate, and so that's what this kind of speaks to.
And Berkshire finishing the day in the red, by the way.
You bet.
Mr. Buffett passing the torch.
Yes, he did. Buffett's bucks. Let's take a look, though, at the sectors that he has been investing in. This kind of compares Berkshire Hathaway to the S&P 500. And what you're going to notice here, I got the top 4, actually the top 8 here. Financials, by far and away, Berkshire's biggest position, and that's almost 40%. That includes Bank of America, American Express. 2 of the top 5 holdings are there. Moody's, Visa, MasterCard, Chubb, another insurance carrier. That compares to only 14% in the S&P 500. When it comes to tech, actually kind of break even though. Before Warren sold his Apple position, that would have been a lot more for Berkshire Hathaway. So Berkshire actually would have been over the S&P 500's allocation in tech. But other than that, you're gonna have to stay tuned. We got some more analysis tomorrow.
We do. Thank you, buddy.
Thank you.
Appreciate it. Stick around. Much more Ask for a Trend still to come. Shares of Limbach Holdings jumping following their latest earnings report. The building systems solution company reporting a revenue beat for the first quarter. Joining me now to discuss is Mike McCann, Limbach CEO and President. Mike, it is good to see you. So I know heading into this print, Mike, your stock was up about 20% this year, was up around 120% over the past 12 months. It's higher here in the after hours, Mike. I know your first quarter is typically your softest, but walk me through the report, Mike, what you're seeing in the business.
Yeah, no, definitely. We're happy that we're off to a good start. I think a couple things to note. Record net income, 10.2 million, which is really exciting. Our shift from new construction, GCR, towards owner direct, we continue that momentum, 67.9%. Good growth from an EBITDA and revenue perspective from Q1. So, our story has been very much about following our own path, and I think in some sense taking a very different path than a lot of other E&C companies. And I think in Q1 we got off to a continued good start.
There is concern, Mike, this about the macro. I've had plenty of smart economists come on the show and tell me they think the odds, the probabilities of a recession are rising. So I'm just curious, when you're talking to customers right now, what are you hearing?
Sure. So, the company's been around a long time, and part of the reason we shifted our strategy is ultimately in periods of uncertainty, the markets that do the best are really mission critical type environments, healthcare, life science, industrial manufacturing. Those type of facilities have to spend no matter what. Other type of less critical environments, residential, those type of environments, they will flex based upon what happens. I think the other thing that's nice about working in these really mission critical environments is in some years they're on a CapEx cycle, on some years they're on an OpEx cycle, but they're going to have to spend those dollars. So it just kind of goes along with our story that working in existing buildings in critical environments, that's what's really helped us. And we believe that will really continue to help us, through any other cycle that ultimately pops up.
What about the Trump tariffs, Mike? I'm curious how that's been affecting and impacting the business.
Yeah, so for us, it's been pretty neutral. Ultimately, prices have risen quite a bit. the one thing that's helped us, and I think, again, we've learned from the past, is our ability to pass along costs quickly. Our projects tend to be very short in duration, no more than 3 or 4 months typically. In our past, when we had long-term projects, it was a lot more challenging because you would set pricing at time of bid, and ultimately you'd have to deal with price increases, and no owner wants to hear that the prices have gone up. So our whole model has been about being nimble, flexibility, and I think that's really helped us. Some owners too, in our model, they may delay an expenditure, but they're going to have to make a short-term repair. And one thing that we've done in the business the last 12 months or so is we've had a rental fleet as well. So if somebody's waiting for a part due to something that's coming overseas, or if somebody's concerned that whether they're going to replace that piece of equipment, we've seen tons of requests from a rental equipment perspective, basically to keep that system running while they make that decision. So a lot of different things have ultimately happened from that environment perspective. For us, it's been neutral, and I think we're always trying to get customers to make decisions quicker, bring information to the forefront, and allow them to have options about what's right for their business.
I'm curious, Mike, just given the macro backdrop, the Trump tariffs we're discussing here, has that affected, Mike, how you're leading this company, the decisions you're making? Just, in terms of investing, spending, headcount.
Yeah. So in some sense, we've always been, we're always trying to build a model that's as microeconomic, independent as possible. And what we've really done is, in some sense, we really doubled down on our customer relationships. And those mission critical environments, this year we've added quite a few different salespeople to our staff. We want to embed ourselves as much as possible. We want to be that indispensable partner where they can't go elsewhere. So it's not so easy if one phase of new construction for a certain company in the E&C space, they can't just dramatically just drop into an existing building environment. So in some sense, we really double down and try to strengthen our relationships. The other thing that's been really important from our customers is we want to make sure that we are presenting solutions. One thing that we're really focused on is gathering data from the customer, whether it's utility bills, facility assessments, asset data, history. How can we go back and analyze that data and present the right solution? And there's always options at the end of the day. So this year, I think, is another great opportunity with some of this ultimately uncertainty that customers hear is say, hey, if you spent this much money the last couple of years, how can I better spend the money going forward? And how can I find incentives to make your dollar go further?
Mike, great to have you on the show today. Thanks so much for your time. Appreciate it.
Thank you for having me.
And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.